welcome to Risk at Work, Risk Connect's educational web series. I'm Scott Fenstermaker. I'm the head of digital marketing. Today, we're going to be talking about the evolution of cyber insurance, understanding market dynamics and coverage realities. Previously on Risk at Work, a few times we have made mention of this term that the industry accepts, risk transference. And the kind of misnomer it usually is, because even when you have transferred financial risk onto another institution, there's usually some vestigial element, some residual element of risk that stays with you, even though you may have cleared the dynamic from your mind, whether it is a form of reputational risk or a form of cultural risk, or even, as we are going to see today, sometimes a form of risk having to do with the policy itself. The delta, for example, between what it actually does cover and what it might seem to cover. And in instances like that, and as we're going to find out today, the area of cyber risk is an area that is absolutely ripe for this kind of discussion. And we're going to learn a lot about this today from our guest. Before I introduce him, though, just a couple of housekeeping points. Number one, if you have questions for our guest today, please put them in the questions field of your webinar software. If we don't answer your question during the course of our discussion today, we will reach out to you directly with an answer from our guest. Also, if you have indicated that you would like CPE credit as a result of seeing this webinar, please watch your inbox after we're done today. We're going to send you a short 3-question quiz. Fill that out, you return that to us, and we will reply to you with your CPE credit. All right, we're lucky to have back today the founder and CEO of Wheelhouse Advisors. He was formerly a global research leader for risk management technology at Gartner. He has been a many-time top authored recipient and a thought leadership award winner. His professional roles previous to that include executive management, finance, risk management, audit, and even IT. Perfect person to have this discussion with today. Please help me welcome back John Wheeler. John, how you doing, my man?
Hey, Scott, I'm doing well. Thanks for having me on today, and I'm really excited about sharing some interesting information on something that a lot of people have heard about, but don't know a lot about what they should know about, if that makes any sense for you in the audience. But I think after this, we'll find that many folks might be going back to their office and picking up the phone to call their risk manager on insurance and start to look in depth at their policies.
I've been looking forward to this conversation because as we talked about offline, this one has the opportunity to catch a couple of people perhaps by surprise and make them look again at what they think they have and what they don't.
Yes.
I'm sure that a lot of people are looking forward to us digging into this material.
Well, great. Well, let's jump right in because we've got a lot of ground to cover. And I'm going to go through the topics here very quickly, and then I'll drill into these in various levels of detail. And this first one, I think, is going to be interesting for folks to better understand how we've arrived at the current state today around cyber insurance as a marketplace and why it remains what I call very murky. And that's why I think those who have decided to join the call today are going to be happy they did. Secondly, I'm going to get into the specifics about what these policies that are specifically designed for cyber risks, if you will, what they really cover, and most importantly, what they don't. We'll also talk about some of the common pitfalls, including exclusions, audits that are more and more a part of the claim process, which you'll discover why that's so important, and a term that many of you may not have heard of, but it's super important for you to understand, and that's silent cyber and how it relates to your insurance policies, specifically those that fall outside of the cyber realm, who are where a lot of organizations may think that they have themselves covered when they really don't. Then we'll talk about how do we take what we know about cyber insurance as a product and incorporate it into our enterprise risk strategy. And this is very important because cyber insurance certainly plays a role, but it's not the total answer to your cyber risk issues. And then finally, we'll wrap up with some actionable steps that you can go back to your office, as I said before, and start to really get into the details around your cyber insurance if you have a policy, or if you're just starting to look into this topic and market for your own purposes, how you can do that in the best and most effective way for your company. So, how has this marketplace really evolved, and why is it so murky? Well, just to let you know where we are today, I'm going to kind of work backwards here a little bit. But today, only 26% of companies who are insured have standalone cyber insurance, which is still very surprising to me. I think it has a lot to do with the fact that the very large enterprises who are using cyber insurance are doing it in very limited ways because of things that have occurred over the past really decade or more. And I'll tell you some war stories here in a moment. And war, not I don't intend a pun there, and you'll see why, but there are some war stories that we need to discuss. But also, I find that small and medium-sized businesses, again, feel like they probably are covered within their general liability, property coverage, maybe their errors and omissions, even all the way up to directors and officers insurance, that those are adequate for their what they may view as limited cyber exposure, which is couldn't be further from the truth. Actually, there's a lot of exposure there that we'll discover here in a moment. But let's take a step back again and see how we've arrived at this point where only 26% of firms have standalone cyber insurance. And just to give you a quick understanding of where this all started, it all started back in the late 1990s, just before the turn of the century. And that's where the internet started to create all sorts of risks for companies as they started to incorporate the use of the internet in their businesses. And the very first product that was launched was actually called Internet Security Insurance. That was the nomenclature back then. But then we started to experience a lot of regulatory concerns around the internet, and this is where things started to get complicated. In 2003, California, surprisingly enough, was the very first state to enact legislation around the appropriate notification of data breaches to its citizens, or even for folks outside of California who were doing business with firms in California. And so this created a whole host of issues for companies in that they had to start to report these data breaches in ways that they weren't prepared to do and notify individuals of this sort of risk or the breach that occurred. And it's something that we as consumers are very familiar with today. I'm sure there's not a single person on the call who hasn't received some letter from an organization letting you know that they have been involved in a data breach, and there are various steps that can be taken because of it. And a lot of that centers around credit monitoring. They'll offer that to you, or they may even offer some form of payment to cover any losses that you may have had. And so that's really where this cyber insurance started to get its legs, because these costs are real to companies, and the insurer saw it as a way to help companies offset the costs related to a data breach. And that was the case for another, I'd say, 10 years. We fast forward to 2013, and this is when I picked up my coverage of cyber insurance at Gartner. And it had to do with data breaches becoming more commonplace, in that the larger organizations started to experience massive amounts of data leakage and data breach exposure. And the big one that I remember and really got me involved in this coverage was the Target breach. I'm not sure if folks recall that breach very well, but just a quick summary of what occurred. Target had, of all things, a heating and air conditioning contractor who had tapped into their network to monitor the heating and air conditioning across their stores. Unfortunately for Target, this heating and air conditioning vendor not only tapped into the network supporting those sorts of devices, thermostats in the stores, but also their point of sale network. And that resulted in, I believe it was 40 million consumers having their payment data breached. And the subsequent ripple effect from that was, not only were these consumers impacted by exposure to criminals who could steal their identity, but also others down the chain, the payment processors, the Visas, the MasterCards, and the banks that were involved all experienced loss around that sort of data breach. And so that's when things really started to take off for cyber insurance, because these are massive amounts of loss that needed to be paid. And in Target's case, I think they had roughly 292 billion, if memory serves, in total loss. Only a third of that, around 90 million of that loss, was covered by cyber insurance. And so my coverage started to focus in on why weren't these policies paying out at the level that a lot of companies expected. And it stems around this next fact: 62% of risk managers still today report attacks, but many don't file claims. And the reason they don't file claims is because they know that their policies, the likelihood of payout may be very low, and the risk of greater or higher premiums may result. And again, we go back to the Target example, just not paying out like it should. And then we couple that with the fact that now 31% of losses are now third party related. And this is up significantly from just 2 years, or just a little over 3 years ago now, from less than 10%. And so these are losses that are caused by, say, someone in your supply chain, or some contractor, again, in the case of a Target, you know, a heating and air conditioning contractor that you wouldn't view as a risk to your payment system. Those are the third party losses that are creeping up, or not even creeping, are really accelerating into 2025. And then on top of that, what we find is that these policies have gaps around what's known as business email compromise. And upwards of 70% of these cyber insurance policies don't cover any sort of email compromise, or something that originated with an email that was fraudulent, that caused some action within the company to result in a loss. And so the typical example that I give is when a fraudulent email may come through requesting a wire transfer, and
Yeah.
it's it's spoofed as, say, the CEO who is requesting this wire transfer from the Treasury Department within an organization, or some other part of the finance department. And once that wire is made, it has nothing to do with a cyber insurance policy, but a lot of people think it does. And then the biggest one that has been very controversial, especially since 2017, when we had, if you recall, the NotPetya global event with the Russian bad actors exploiting systems throughout every major organization across the globe, that these sorts of either ransomware attacks or malware attacks are viewed by insurers as acts of war, that they're state-sponsored attacks. And many insurers, even back then, have had carved out these acts of war, state-sponsored attacks, as exclusions within the cyber insurance policies or the standalone policies. But where a lot of confusion occurred and it led to a lot of legal activity was around policies that weren't standalone cyber. So your general liability, your property, your other policies that remained silent, and this is where the term silent cyber comes from, it remained silent on what these sorts of events around malware, ransomware that were state-sponsored attacks, how it would be covered or not within those policies. And so two examples that had a big impact on what we're dealing with today. You had one, Merck, the pharmaceutical company, sued its insurer, Ace, and they actually had a positive result. The court ruled in their favor, and the claim that they made, which is $1.4 billion related to the NotPetya loss, that fell under their property policy, it was paid out. But at the same time, another example is Mondelez, the candy company that you might, and snack company that you might be familiar with. They filed suit against their insurer, Zurich, and they didn't have as good a result. The court actually never had an opportunity to decide on the case because they settled out of court with Zurich right before a judgment was planned to be made. And so that settlement, while it was private, in many realms, legal circles, it's assumed that it was much lower than what the claim was actually that was made by Mondelez. So I think this can give you an idea of where we stand from a market perspective, but how does this apply specifically to you, this murkiness in the market? Well, the fact that, as I mentioned before, many companies are reluctant to file claims around a cyber event, this puts the insurers at a disadvantage because they have limited actuarial data on which to do broad-based underwriting. And so what does that mean for you? Well, most buyers of this insurance will typically only receive a quote sheet rather than the full policy itself. And this is through your insurance broker. And again, when I covered this at Gartner, I reviewed thousands of policies on behalf of our clients and also reviewed them against the quote sheets that these companies would typically receive. And the two really didn't, I would say, match up, if you will, in that those quote sheets did not list the exclusions, or more importantly, the sublimits within the policy itself that gives you a true understanding of the value or lack of value thereof or therein the policy itself. And so the insurance companies, because they don't have this actuarial data on which to perform their underwriting, they have to do it on a case by case basis. And what that means is for you, when you go to purchase this insurance as a standalone policy, you will receive a very detailed questionnaire that is typically completed by your Chief Information Security Officer because it's focused on your security program and how well you are positioned to respond to a cyber attack. And as we've seen an increase in the variety and complexity of these cyber events, these questionnaires have become much more detailed and, to be honest, very difficult to respond to. And that's why 36% of companies today say renewals are so much harder, because when the renewal comes up, they're asking them to complete a new questionnaire. And those questionnaires can sometimes exclude you from renewing your policy because it points out a significant gap you may have in your security program. The other thing that we see today is that legal and enterprise risk management, the groups within your companies, are rarely involved in that policy evaluation up front. And why is that important? Well, legal, of course, I think it's a little bit clearer why they need to be involved from just a pure legal risk perspective. But more and more, as these cyber events become third party based, organizations that you may be outsourced to, that you are dependent upon from a supply perspective, it's within those contracts that have been made where a lot of the remedies for these cyber attack losses are found, and whether or not that third party has appropriate insurance in place to cover that, to provide an offset, or if the company itself is going to have to insure for that through its own standalone policy. And then secondly, ERM, I think the big thing here is that they are the one group that has the forward-looking view around where the company is headed from a strategy perspective. And more companies are creating new digital products and services that are exponentially increasing the amount of risk as it relates to cyber. And so ERM needs to be involved upfront on this policy evaluation to make sure that these policies are fit for purpose for where the company is planning to go.
Okay, let's pause here for just a second because we've gotten a lot of data through us so far. Some of these things really bear highlighting before we move on, right? Because I don't want certain points to get lost in the data here. So I want to talk about some of these things that you're finding as sublimits or carve outs, right? And just how prevalent they are. The first one, which when we were talking about this offline, really grabbed my attention, was that it's if what I hear you're saying is correct, that cyber attacks and risk events by state actors are very often not covered because they are considered acts of war and carved out of a particular policy. I don't have the statistic with me, but I get the sense that state-sponsored cyber attacks are very prevalent, if not the majority of cyber attacks as we're talking here in 2025. In other words, that it's, I wish I had the statistic, but that it's a very prevalent piece of cyber risk events. Do you have any kind of sense of that?
Yeah, my latest research shows that those state-sponsored attacks probably represent just over a third of the
Okay.
attacks today.
So a
And
considerable amount. It's a
yeah,
minority, but a third of potential attacks that we're talking about are already carved out in a lot of these policies in common practice.
exactly.
Correct?
Yes, yes.
The next one, I'm doing this from memory. We talked about an increased amount coming from third parties, and you mentioned the HVAC vendor, right? Is is it practice for uh, cyber vulnerabilities introduced by third parties to be cut out of such policies or to be covered at a lesser degree? If I had a vendor, for example, that introduced a liability, can I be denied on that basis?
Yeah, and where we see it most is around business interruption.
Okay.
Uh, so business interruption coverage is focused on the losses that you incur as a result of your business being shut down. So the
Mhm.
revenue loss that you have, the impact that it may have on your customers, your downstream, supply chain folks that you're providing to your things like the banks, as I mentioned in the Target example, all that business interruption, it typically is the largest cost that organizations face. And in every single standalone policy, and I'm going to get to this actually, I'll just jump here.
Sure.
It's often excluded or it has to be negotiated as an add-on. And
Okay.
even further to that, so that's business interruption of a first party nature. So whatever interruption that you may have within your organization. Where you also need to go is what's known as contingent business interruption. And that really focuses on the losses caused by an upstream supplier, for example, or by the heating and air conditioning vendor. You know, that's where it started. And a lot of this business interruption, the sublimits or the exclusions, if you don't have that contingent in place, it will carve that out.
Mhm. And finally, and I'll let you move on here, but something that really caught my ear when as you were going through it was at the very beginning. You said that vast minority of cases are reported, and that risk managers feel hesitancy to report cases because there's a real risk that the loss will be contested under such a sublimit or carve out, while at the same time an absolute certainty that the premiums will increase.
Yes.
Do I understand that correctly?
You do, and there's another wrinkle to that that I don't want to get to yet,
Okay.
but
I don't want to
I'll
steal
tease
your
it.
thunder, but
Yeah.
that seems to me that seems to me highly problematic. Maybe I'm making too little a deal of it, right? But a policy that risk managers don't want to exercise even legitimately because of ramifications of exercising the policy.
Exactly.
If I'm hearing you correctly, which is
Yeah.
it blows my mind a little bit, but you get the idea, right?
Oh, yeah, yeah, yeah. It's creating all sorts of behaviors around the claim filing, claim
Mhm.
processing, and I'm going to go ahead and
Yeah,
open up
let's.
the can of worms, but
Yeah,
it all has to do with the nature of these policies hinging on what organizations provided in that initial questionnaire. And the
yeah,
reason why is because insurers will use that questionnaire as the basis for determining whether or not they're going to pay the claim, and
right.
most importantly, whether they're going to continue insuring you. And so I'm going to leave it there for a moment, and I'll get
Yeah,
back to
leave
it.
that there. I don't want to steal your thunder. I know you're going to get to that here. Let's continue on, but I think that some of those things are worth highlighting because I think it goes to the core of your message here about sort of the difference between maybe sometimes how these policies are presented or what people might assume to be covered in there with how they work in actuality.
That's exactly right.
Please
So,
continue.
just going back to this slide, I wanted to make clear what cyber insurance as a standalone policy typically covers. And what I typically communicate to clients is the fact that cyber insurance is somewhat of a misnomer in that it really is focused on a data breach and the costs associated with a data breach. And that goes back to the timeline that I gave you, starting back with the state of California in 2003. That legislation push spread across all 50 states in the US. Unfortunately for companies, every single state has their own unique rule set as to what needs to be disclosed, what needs to be communicated to those impacted by the breach, how organizations need to go about determining who is at fault and what occurred. All those costs have to be considered as part of a cyber insurance policy, and really where this all started. And so the core of a standalone policy is around those data breach related costs. Forensics I have here. So the very first thing that any company has to do after a data breach is bring in a team of forensic experts to determine where that breach originated, and then go through the whole process of who is impacted, create those notifications, the mailings out to the millions of folks potentially who are impacted, set up credit monitoring for those folks, and on and on. These sorts of costs are adequately covered within that standalone policy. What I found in reviewing the policies is larger organizations typically have ready access to these sorts of services. It's the small and medium-sized businesses who, when something like this occurs, they don't know where to turn. It's not something, they're not dealing with these sorts of groups on a regular basis. So this is where one instance where I can tout cyber insurance as a standalone policy is having some real value is for these small and medium-sized businesses who can turn to their insurer who is contracted with folks across these various areas of need, and are prepared to jump in, parachute into your organization and take care of these things. And, it's not out of the goodness of their heart that they're doing this. Of course, they're there to limit the amount of loss and the amount of cost that they're going to have to cover as part of a claim. So, it's a two-way street. But where a lot of confusion starts to come in is what we were just talking about, and other types of losses that are much greater in terms of amount and exposure that may not be covered. And it requires a lot of detailed analysis of the policy to determine whether it's covered in the standalone policy or how it relates back to your broader business policies in the realm of general liability, property, what have you. And so business interruption we've already talked about, but it goes even further into ransomware or extortion payments. A lot of times these are excluded, but when they're included as an add-on within the policy, the standalone cyber insurance policy, this falls into the category again where I see a lot of value, because typically organizations aren't dealing with experts in this space who can negotiate the very dark world of how to negotiate some form of payment, and if an organization decides to make that payment, how to go about doing that. Because most often it's not a direct wire or writing a check of money. It's caught up in the Bitcoin, the blockchain type of world, so that it can't be tracked back to the bad actor. And then finally, legal liability. And this is where, the exposure can be infinite, depending on how the court rules. But if you've got a third party fallout where you have experienced some form of cyber event, a breach, ransomware, malware that impacts others, that liability, it has been part of the silent cyber issue where a lot of organizations look to their general liability policies and the courts had differing opinions. But I will tell you, within the last 3 years, I know, and this began with Lloyd's of London requiring all of their syndicate firms to what's known as affirmatively defining this sort of legal liability as it relates to cyber, defining it both in the general policies, but also within the standalone policies. So it's very clear where the limit lies. And so this creates even another area that you really need to pay attention to when you examine that standalone policy. All right, so I know, Scott, this made you laugh a little bit when we were looking at, and many of these claims are dead on arrival when they're made. And the primary reason is going back to that questionnaire that I mentioned. What these insurers do, and they're really limiting the amount of loss that they are going to experience, is that they will take that questionnaire that you filled out, and it could be, a couple of years ago, depending on when you experienced this event and your policy is still in effect. They'll look at that questionnaire and they'll compare it to what your practices are. So they'll actually come into your organization and audit your security program. If there's any discrepancy between what you said you do and what you're actually doing at that point in time, regardless of whether you were doing it before, they will deny the claim. And I think a big reason a lot of companies avoid filing claims is they will realize as a part of a cyber event that what they answered in that questionnaire was not accurate because they experienced the cyber event. The controls that they said were in place, maybe it's multi-factor authentication or some sort of access control, wasn't there. And they know as soon as they file the claim, the insurer is going to audit and determine that they weren't accurate in disclosing that sort of control discrepancy or deficiency. And so they will, in order to keep the coverage, because that's the real risk here. It's not, the premium will probably go up for sure if they pay out. But most importantly, can they keep the coverage? And, there are all sorts of coverage drops or, renewal rejections around that very issue. The other thing that companies, I think, realize once something happens to them is that it's broader and there are greater ripple effects throughout their business operation than just that, say, data breach or ransomware event. And so most of these attacks, especially now in 2025, they are impacting the business itself. I mean, cyber is now a true business risk. And the majority of these, almost 3/4 result in moderate or significant financial loss. And not only do you have the loss itself, you have the time involved. The recovery can take a month or more. And so I just want to drive this home. I can't say it enough. This claim denial risk is highest when the controls that you said you have in place don't match the questionnaire. And this will go to one of my big recommendations when we get to the end. But what it really highlights is a need to better understand your risk landscape across the business, now that cyber is truly a business risk. And this is really the core of my organization, Wheelhouse Advisors. Our value to you and our clients is that we help organizations better understand, gain greater visibility, and start to map these risks together across 4 key domains. And you'll see it here in our IRM Navigator framework on the left-hand side. It spans enterprise risk, operational risk, technology risk, and GRC, or governance risk and compliance. And while the cyber risk really emanates from the bottom here with technology, it quickly spans the realm of these other 4 risk domains. Certainly we talked about the compliance impacts from the likes of the state's breach notification laws, but also more and more as we get into artificial intelligence and its use within new digital products and services, we're going to see that sort of regulatory requirement on steroids over the next 5 years. So GRC is going to have a huge component. From an operational perspective, as organizations continually transform from a digital perspective and automate their manufacturing processes, or maybe auto manufacturers who implement digital mechanisms or data feeds from cars into their own network, whether it be, autonomous driving, or even have an example of a major car manufacturer who actually had to pull their product off market because it resulted in a data privacy concern. It was a connected car type of product that allowed the car manufacturer to see what was going on at all times in that car, and really not in a nefarious way, but to help them troubleshoot and help to maintain the car by getting readouts as to how the car was performing. But little did they know, it created a huge liability for them from a data privacy perspective. And so those sort of operational impacts have to be considered, and bleeding up into the overall enterprise risk, understanding strategically, where you're headed and whether you've planned for those unknown risk areas. And it really requires, in my view, and what we are recommending to our clients today, is to adopt a very mature scenario analysis capability, so that when you start to design these new products or services, that you can scenario out the potential implications that they may have. And without doing that, not only will you lack that visibility and understanding of the true risk exposure, but then you tie it back to a cyber insurance policy, you'll have a better understanding of the true coverage that's required. So this is where the rubber starts meeting the road. I'm going to give you some key steps that you can consider as you start to head down this path and aligning cyber insurance with your risk strategy. First and foremost, it's mapping those policy terms. So you've got to get the detailed, thick policy document and map that to your known digital and vendor risks. And again, the vendor risks are so important now because of that uptick that we're seeing in third-party related attacks and breaches, ransomware, malware leading to business interruption. Also, you've got to make sure you have all the key players involved, and that includes all the key risk players: legal, compliance, enterprise risk. They have to be at the table and involved in that policy evaluation. Again, too often it's limited to the technology folks, the chief information security officer. And while they may be the expert around what sort of controls exist around the security program, they don't necessarily have the understanding of how it extends throughout the organization or into the broader ecosystem of third parties, potentially, or they just don't have the expertise in understanding the insurance coverages and the insurance mechanisms in play. Third, once you have that understanding, again, it goes back to the scenario planning and testing how you're going to respond to these different types of events. And what we recommend to our clients is those response plans include the insurer. So you need to, and this is before you buy the policy. I think it's very important that you do this, is you walk through these scenarios with the insurer and say, um, how do we go about filing this claim? What information do you need? If we're going to engage you along the lines of those services that I mentioned, forensics, breach notification, what have you, how are those resources going to be engaged and how quickly? And it's not only what they're going to cover from a loss perspective, but how timely are they going to offer this sort of response? Because time is a big factor here. It also helps you zero in on what the coverage amount should be. So are you overinsuring or underinsuring? And the scenario analysis should include a quantitative modeling exercise in terms of what is the expected loss that you anticipate. And then finally, you've got to, once you've completed all of those tasks, go back and validate that everything is as it is and how it should be going forward. And again, the questionnaire, I think, is the best example here. You want to make sure that that questionnaire is rock solid at the time that you send it in, but also there are processes in place to make sure that it is kept up to date. So, and that's where it typically fails, is that questionnaire, something happens, controls are either weren't there in the first place, so wasn't enough validation on the front end, or they may be removed, due to some new process or product or service, and making sure that the consumer's need is met. Or, a lot of cases I would see, through mergers and acquisitions, a lot of these controls would just fall by the wayside. So there are all sorts of events that you want to make sure are plugged into that questionnaire. All right. I'd like to start here by talking about the most important things that you can do to ensure a successful purchase of cyber insurance. And I don't want to sound like I'm beating a dead horse, but I'm beating a dead horse. And it's really important to get these things right as you go through the activities that we just discussed. And I'm sure as you leave this call, if there's one thing that you will remember, it's you've got to request and read the entire policy. Don't just rely on that quote sheet. When you're reading that policy, you've got to get into the weeds and look into the sublimits and the exclusions, specifically around war, acts of war, um, also extortion. I probably didn't call that out enough, but we did talk about the ransomware needing to be an add-on to the policy, because in most cases that is excluded from the base cyber insurance policy that you may receive. And a big area of exposure that companies don't realize until they've been hit is around that business email compromise. So that spoofed or fraudulent email that comes in that creates some sort of activity that leads to a loss, that's typically excluded. So you want to be able to negotiate that back in, or see if it's covered within another policy that you may have. Third, you need to assess the alignment with your top risks and your breach history. And this is where I think the questionnaire comes into play, because it will start to surface those gaps and controls that you may have. But in working with your enterprise risk folks, and this goes to step 4, it will also make you focus into the future, what are your strategies for the company? Where are you looking to grow your business? So not only what are the technical incidents that you've experienced and now you're controlling for, but what products and services are you going to be bringing on that may increase your cyber risk? So involving the CISO and ERM in a sign off of that policy review is super important. And then finally, making sure you go through the modeling exercise and scenario analysis of what you do when that claim occurs and what happens if it's denied. So here is where I get to one of my big recommendations, and that is that it's important to remember that cyber insurance does not equal resilience. It's a tool in the toolbox, and it should be used as a tool. And to do that effectively, it should be focused on how can we transfer the risk and be covered from specific losses related to the cyber event, but understanding it's not going to cover everything. And so to cover everything appropriately or to the extent that you can, it really takes investment in your risk management programs, whether it's in the realm of enterprise, operational, technology, or compliance risk. And that's really where I have here the formula GRC, ORM, and TRM. Those come together as your security foundation, supporting your enterprise risk management focus. And insurance really is just the final layer, kind of the layer of risk protection that you may have to offset that catastrophic loss that you may experience. But day in, day out, you've got to have the blocking and tackling covered, because not only is it going to help you be more resilient, it's going to help you qualify for the best insurance that you can get. So it's not unlike any other form of personal insurance. And automobile comes to mind because my wife just had an accident. And
All right.
oh no, actually it was a minor accident, thank goodness, but it was a result of her texting and driving. So she's learned a good lesson there. But it just goes to show you've got to have good practices in place. From a car insurance standpoint, you've got to be a good driver. And I'm not trying to call out my wife or women in general. Don't want to be accused of being sexist here, but it's so important to be a safe driver and to do the things that you need to do to make sure you're driving safely. And then, accidents happen. And so that's what we rely on insurance for. Same thing with cyber insurance. You've got to view it in that context. So just to put a nail in the coffin for, again, no pun
Getting
intended,
macabre here, yeah.
dead claim. Cyber insurance is not going to save you. I hate to say. And more than likely, especially if you didn't attend this webinar, it's probably going to let you down. But if you're prepared and you understand what it can be used for in a broad-based integrated risk management program and approach, then you will be successful in using cyber insurance.
This information has made a huge impression on me, and I didn't know much about this whole realm before you and I had this conversation. The comparison that you made at the end, specifically to like a catastrophic insurance, I think is particularly apt. This reminds me of like one of those stories where you know call 911 and have the ambulance come to your house, and it's only after you submit the claim do you realize like the ambulance was out of network or something like that. In other words, the idea of not knowing the extent of your coverage till after you file a claim and test out, were you really as compliant as you said you were in the questionnaire? Did anything accidentally drop that you didn't know about? And what are the ramifications of that? So I think that is going to make a huge impression on people. Maybe we just have time for one question, but I'm curious about the relationship between this kind of insurance, this kind of risk transference, and executive leadership, right? So, um, what is the dynamic there? Is executive leadership really driving this? Do they typically have an idea that that it makes you more safe than it does? What are the factors that are driving the adoption of cyber insurance? How does that relate to executive leadership? And what, if anything, do you think executive leaders have to learn about cyber insurance that they may not know already?
Yeah, and I'm gonna throw some cold water on this based on my experience and dealing with senior leaders.
By all means.
And that is most boards and senior executive teams, they're the ones that haven't experienced a cyber event, which the number is, getting smaller every day. But those that haven't, they're just looking to check the box to say, yes, we have cyber insurance,
Sure.
or, it's included in our coverage. Um, what they don't tend to think about is when they're in those strategy sessions, when the CEO is, presenting his or her plans for growth, they don't factor in cyber risk into those discussions and its impact on the broader business and success of a given strategy, especially as it relates to something that's very focused around a product launch or offering a new service. That business case really has to include the potential for loss as it relates to cyber, but also the potential for interruption around that particular strategy, around that particular product or service related to the technology element. And I first started seeing this as a concern on the agenda for what I would call the companies who had leaders who were very aware of their lack of understanding and visibility
Mhm.
back in 2018. So when I was at Gartner, we would conduct an annual survey of CEOs, and that survey included asking them what were their top 10 business priorities for a given year. 2018 was the very first year that risk management made it onto that list. And all years before that, not even close. And when I look behind what was driving that priority, it was the fact that CEOs, especially the real true visionaries, as I would say, they saw that in this decade that we're in, right, that's smack in the middle of, that the only successful way that they were going to continue to grow, especially in the ways that investors and other key stakeholders are expecting, is through digital, through
Mm.
technology. And that's the one area that a CEO or other senior leader and even the board of directors that they intuitively lack the understanding of that sort of risk. Most of those folks, they grew up either within the business itself or in the given industry, and intuitively they have a real good feel for the risk landscape. This, though, is something altogether new. And so in 2018, those CEOs who saw it as an opportunity also realized, hey, I've got to start investing in risk management in this arena uh, to ensure that I can achieve those growth targets. Now we're starting to see it again, as companies start to launch a product or a service and pull it back off because of a unexpected sort of risk. The rubber is starting to hit the road. And so it's even more important, I think, for organizations to have a really solid understanding of cyber insurance, but also of the integrated risk landscape.
That's great words. We'll have to leave it there. John, thank you very much for joining us today. Thank you very much to our audience for spending some time with us. We'll see you on the next installment of Risk at Work. Take care.